Hey guys, Jared Wesley here of Live Traders, and it is that time of the week. It is lecture time. This week's topic, guys, I'm going to go a little bit different, a little bit off topic, so to speak, but we're going to bring it back into trading a little bit. So this week's topic is why the rich get richer. Why are successful people so successful? And why is it that they continue to be more successful? Well, this week's topic is going to delve deep into that, but we're going to do it and we're going to relate it to the stock market. Okay, many of you out there are cursing the markets when the market pulls back. 2008, 2009, you should have heard all the comments people had about the stock market. All those Wall Street crooks, this and that, blah, 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 blah. I'm never, ever going to invest in the markets ever again, blah, 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 blah. And then the market goes up 500%. And you're sitting there with your hand in your pants, all right? And you're watching all these other people make money. You're going, oh, he's just lucky, or she's just lucky, or whining and crying like little baby bitches, okay? That is not how you make money in the markets or any other way in this world, okay? The way you're going to make money is to man up, not be a victim, and take control of your life. So we're going to talk about that as it relates to the stock market. Why? Because we are in a time of opportunity. And you can't tell me if you watch this video a year from now, 5 years from now, 10 years from now, that you didn't know, because you're about to find out. All right? So the market this year is getting beaten up pretty good. It's probably going to get a lot worse in the next 6 to 12 months. You can come back and replay this 2-3 years from now and see if I'm right or if I'm wrong. But instead of cursing the markets, start participating in the markets. But you don't buy the all-time highs, you buy the pullback. So again, today in this lecture, I'm going to show you how to do that. I'm going to show you the price point and levels you should be doing that, and also the mentality it takes to become wealthy. All right, so I am Jared Wesley of Live Traders. If you like these videos, please click the like button, hammer that subscribe button. Let's get to it. This week's lecture topic is why the rich get richer. Oh my goodness gracious, what a topic. A hot topic because many people have a victim mentality and they feel that rich people are just, I guess, what do they call those? Lucky sperm club people. That most of their money is inherited, which is absolutely, utterly false. 70% of the Forbes 400 list are self-made. Somewhere in the neighborhood of 97% of millionaires, okay, whether you want to call that rich, that's up to you, but 97% of millionaires are self-made. So first and foremost, scrap all the crap. Most very successful people have earned it. There are certainly exceptions. The reason I'm telling you this is so you won't make an excuse. I was born into a guy who was a plumber. I don't have a chance. BS. But we're not just going to talk about wealth building, because that's not really the purpose of this lecture. The purpose of this lecture is to help you guys gain an understanding of why rich people get richer, but how you can partake in some of that. So while yes, there is a wealth building aspect to it, really we're going to look at some charts, specifically looking at the market, so on and so forth. But before we do that, first we must talk about when will the insanity stop? Guys, not all of these are joyful. I mean, in fact, most of them are not joyful, but some of them are worse than others. I mean, some of them you see somebody lose money and you're like, whatever, that guy was stupid. Some of them are just sad, and there's really nothing. You don't want to beat a dead horse or really, hammer the point home too much. But this is one of those, kind of sad ones. Do you know what I mean? Leverage crypto trading just destroyed my life. Okay. 8 months ago, I went to play tennis with a friend. I had never owned or even thought about getting into crypto. He recommended some coins he was into, and just like that, the same night, guys, I downloaded Trust Wallet and bought my first coins. Okay. Blah, 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 blah. I made some money, 300% run up. Life was good. Then this shit allowed up to 20x leverage. I remember the first night not really knowing what I was doing. I deposited $1,000. I lost it in minutes. Went, deposited again and again, okay? This is already not starting off to be a good story, right? When I was younger, I had a serious gambling addiction to roulette and baseball sports betting. Well, then trading probably isn't the right business for you, Okay? That's where mindfulness comes in, the understanding that, hey, my personality might not be suited for this type of business. Okay. Anyway, back to the story. For the past 8 months, I've done nothing but lose money, chase losses, and completely degenerate. I've lost all my savings, all of my money gone. I'm in debt. I've lost maybe 150,000, but I don't even know anymore how much. I'm exhausted, consumed, drained. I can't think straight. I want to disappear. Okay? I've ruined my life. Wait for it. My wife's life and my 4-month-old baby girl's life. My wife has no idea what I'm up to. I'm a piece of shit, a liar, and a thief, a sick human being. Well, all of those things are true. Okay? You see, this isn't about this person anymore. You're married with a kid. I mean, this is just, it's unacceptable, right? I mean, selfish and unacceptable. It's unfortunate that people put themselves in this position. And don't kid yourself. This happens to a lot of people. I mean, what are you going to do? Be smarter, right? Don't be a fool. Money management matters. Having a stop loss matters. 20x leverage isn't even that bad, Mike. Some people get 100x, go to 4x. You can get crazy leverage. Many, many years ago, I was at a prop firm. My highest leverage you gave me was 330 to 1. 330 to 1. But there were daily loss limits there. This is something that's just sad, you know. This person's life is ruined. This person's wife's life is likely ruined and doesn't quite know it yet. And a 4-month-old baby girl. And the last thing I'll say is everyone's situation is different. But I would imagine $150,000 probably a lot of money to this person. And in 8 months, they were able to destroy it. But I can promise you it's going to take a lot more than 8 months to get it back. That's the part I want to leave you with. It's a lot easier to spend it to lose it than it is to earn it and make it. That's the one thing you need to keep in mind anytime and every time you think about spending money or doing something stupid. Right? I don't care if you're going to buy an iPhone. I don't care if you're going to buy a car. Whatever it is, think about how hard you earned or how long it took you to earn that money. And now you're putting it into a depreciating asset. Or in trading terms, hey, I have 10 grand in my account, 50 grand in my account, 100 grand in my account. How long did it take you to save up that 50, 100 grand? And how quickly did it take you to lose it? Give that some thought, all right? This is a serious business, okay? Treat it like one. Yep, building wealth takes the stairs, losing wealth takes the window is exactly right. Okay? And I agree with that too. You become the type of people you hang with. To change, you need to associate with the types of people you want to become. Very true. So now, let's move along. Why the rich get richer. All right? So this is just a general basic information slide before we get into what I would consider kind of the important stuff. All right? So they have money when no one else does. Well, that's obvious, right? Back in 2009 or 2010, you did not need to be Einstein. You didn't need to be a rocket scientist to make money in real estate. Why? Because people were giving it away, literally giving real estate away. You know, 05, 06, it peaked. By 2009, 10, and 11, it was hitting the floor, and banks were like, just take it. It's a foreclosure. Just take it from us. It was a house that was $1 million, and now it's 500 grand. Just take it away. You need to be a genius. You just needed to have money. But most people didn't. Why? Because they are part of what I call the average. And the average is part of the trend. And you don't want to be part of the average trend because the average people are always behind the trend. They never lead the trend. They're always behind the trend. All right, these are the people that bought their home in 06 and 07 at the peak and then foreclosed on it because it was in one of those ninja loans, right? No income, no job, that kind of thing. Stated income, are you kidding me? What a joke that is. So people need to take some of the blame for this. They blame the banks for all of this stuff, but you need to take some of the blame. You knew you didn't make 200 grand, but you took the loan anyway. So the question here is, Why do the rich have money when no one else does? Well, they live on less than they make and they save the rest. That's the general principle. They live on less than they make and save the rest. For those of you people that need a little bit of a motivator, go read The Millionaire Next Door. And you'll understand that the vast majority of millionaires in this country are very average people doing very normal things. See, the problem is most of you are focused on the Kardashians of the world, the Bill Gateses of the world, the Jeff Bezoses of the world. That's what most of you are focused on. That is not the average millionaire. Look, I'm not going to lie to you here. The chance that you become a billionaire is very, very small. But the chance that you can become a multi-millionaire is huge. It's massive if you want it. Okay? So stop focusing on Kim Kardashian or Jeff Bezos or Justin Bieber or Bill Gates. Focus on you. Okay? Most of these people do normal things like buy a Honda Accord instead of a BMW. Buy a $300,000 or $400,000 or $500,000 home instead of a $1.2 million home. Okay? So they live on less than they make and they save the rest. They don't wonder if it will rain. They prepare for when it will rain. It's not if. Guys, it's not an if there's ever going to be a hurricane in Florida. It's when is the next one going to happen. But you all live like it's never going to happen. You do. The vast majority of people listening to me right now, you know it, it hurts you, and you don't want to admit it. You are living like it will never happen. It's going to happen. It's just a matter of when. Okay? They don't buy things in overinflated markets, houses, cars, luxury items, watches. Guys, seriously, a year ago, for those of you out there that like watches, I happen to like watches. Do you know what a Rolex Daytona Panda was going for those of you that are into watches? $50,000, $60,000 6 to 12 months ago, 2021, early 2022. You know what the MSRP on that watch is? 13 to 15 grand. 13 to 15 grand. And there are people that were buying them for 40 to 60. Stupid, dumb, idiotic. And some of you have one on your wrist and you're listening to me right now. Stupidest thing you've ever done. Maybe not. You may have done stupider things. You don't buy things in overinflated markets. You buy things in depressed markets. You exploit. I'm sorry, it's mean, but it's just a fact. You exploit other people's pain. That is how you get wealthy, okay, in terms of buying things. You take it off somebody else's hand who overpaid for it, and you buy it for 30 cents on the dollar when they need money because they overextended themselves. Okay? Because you don't do that. Because you live on less than you make and you save the rest. You don't wonder if it'll rain. You prepare for when it will rain. You don't buy a house at the peak of the market in 2022. You buy it in 2019, 2018, 2017. Or 2011 if you're really smart, which is when I bought a lot of my industrial. Okay? Impressing their friends is not a priority. Financial security is. How you look to your neighbor shouldn't matter to you. I am not saying you shouldn't iron your clothes and look like a rag doll. I'm simply saying Marshall's Home Goods has some great sales. You don't need to be at Gucci or Gap. Live like that, and trust me, you can still live very, very nicely. Instead of buying the new BMW, buy the 3-year-old BMW after it's depreciated 40 or 50%. Do that. Okay? They very closely, and this one is very important. I have been affected by this. Everyone has been affected by this. Okay? They very closely monitor lifestyle creep. This is a very real thing. Lifestyle creep is a very, very, very real thing. Now, I am not suggesting that some of this isn't okay. So, small amount of lifestyle creep is fine. You've earned it. If you go from making $50,000 a year to $100,000 to $150,000 to $200,000, I wouldn't necessarily expect you to stay in your starter home at 1,300 square feet. Maybe it's time to upgrade to a 2,500 square foot home. but you're still not going to overspend and overpay for it. So a small amount of lifestyle creep is okay. But living beyond your means where you make $10 but spend 12, that's a problem. And that's what most people do. They value shop for everything, not just clothes and cars, but stocks and houses and everything they do. They wait while everyone else buys, and they buy when everyone else is selling. Okay? They have a plan, and they are disciplined, patient, and persistent with their approach. This is what successful people do. You can sit here all day long and you can cry and whine and bitch and moan and act like a victim. Yeah, but so-and-so's dad was a lawyer and my dad was a plumber. Well, you can't help that. That so-and-so's dad was a lawyer and your dad was a plumber is irrelevant. You are where you are. But that doesn't mean 10 years from now you can't be in a better position than where you are today. Don't complain or compare yourself to other people's lifestyles. I've said this many, many, many times before. The guy who comes from a poor family and gets to a point where they make 150 grand a year is probably more impressive than the kid who went to private school and whose parents put them through college and they're making $500,000 a year. Yeah, you might make a third of the money, but they had all the advantages. So what you did might be more impressive, but the point here is where you start from is not what this discussion is about, because everyone will start from somewhere else. It's where you're going that matters. That's the only thing that matters. Where you are, fine. It is what it is. You don't get to choose that in life. Where you're going is what matters. And trust me, you can have a dramatic impact, both good and bad, on your life by making good or poor decisions. And one last quick thing. You guys have heard me say it a million times. If you're listening to me right now, you're in the top 1, 2, 3, 5%. Why? Because you probably live in a country that's a first world country. 3-4 billion people on this planet live in dire poverty. They have it way worse than you. So when the next time you go look in the mirror and try to make an excuse to the person in the mirror, think about the person that's living on $3, $4, $5 a day. Because you're not. You're not. You're not living on $1,800 a year. Admit it. You're not. So stop making an excuse. Okay? So you must prepare before the storm, not during or after. So now, how does all of this get us back to trading? So now that we've set the landscape for why rich people are rich, why they have their money, okay? They live on less than they make. They don't wonder if it'll rain. They prepare for when it will rain. They don't overbuy things, especially in inflated markets, okay? They live on less than they make. They're not trying to impress their friends. They monitor their lifestyle so that the lifestyle creep doesn't get out of control. Slightly, a little bit of it's okay. Too much of it's terrible. They value shop for everything. They wait to buy things. They don't make impulsive decisions. They have a plan. They're disciplined, patient. We have the outline for what you need to do to be successful. Now, let's turn this into trading. The market cycle. Okay? For those of you who've taken professional trading strategies, and some of you that are waiting, wink, wink, most stocks and the market itself, okay, they work in stages. Okay? And honestly, human beings do this too. This isn't related to the market. This is related to everything that human beings touch. Okay? It's just the way we are wired. Okay, but sadly, you would think it would be average or normal to be wired in a way to make money, but most people are not. They're wired in a way to lose money for themselves. Okay, so when we think about the market, we think about 4 stages. Okay, now some of these stages are shorter or longer than others. They don't always look perfect and beautiful. Sometimes you have a stage 1 that's a V bottom and it's very quick. Sometimes you have a protracted 3-year stage 1, okay? But basically what we're looking at here, and don't worry, you'll see a slide here soon. Stage 1 is accumulation, okay? Now, I want you to think about that word for a second, okay? Why is this word important? It's important because it's exactly what wealthy people do, and it's where they do it. You'll see this will make more sense in a couple minutes when I show you the chart. Now, for those of you that already been through the market cycle, you know what I'm talking about. Guys, you don't accumulate stocks at the top of a demand stage 2 period. You accumulate them at the bottom on the cheap, okay? So the first stage is a sideways come see, come saw, no one really cares, accumulation period associated with the fairly uneventful emotion of apathy or indifference. No one really cares. They're not into the market. It's like, the market's, I'm uninterested, I'm disinterested, okay? Not always, but usually, stage 1's a narrow, quiet stage with limited activity. Typically, it has lower volume and a general lack of interest. Okay? Well, think about it. When no one else is interested is exactly when you should be. Let me repeat it. When no one else gives a flying F, that's when you should completely care. All right? So what happens is we go from stage 1 into a stage 2. All right. And stage 2 is an uptrending greed or demand phase. Okay. It's associated with lots of buying from greedy traders and investors. Okay. Stage 2 is usually a wide range move with increased volume and lots of activity. This is a stage where many people make money and greed is dominant. What was this? This was pretty much March of 2009. Up until about 6 months ago. Sure, we had a couple pullbacks in there, right? The COVID pullback of March of 2020. But basically, the market went 10 years, 12 years, 13 years of just greed and more greed. The government prints more money, more greed happens. You are not buying during this phase. Now, you can buy a little here or a little there, fine. But the vast majority of your buying does not happen when everyone else is buying. It happens when everyone else is selling or sitting and doing nothing. Okay? Stage 3, this is a sideways distribution period associated with a lot of back and forth, tug of war between buyers and sellers. It's generally a sloppy phase, sloppy stage, okay? It's the buyers going, it's going higher. The sellers are going, no, it's going lower. And again, there's that tug of war, right? The buyers and sellers are arguing who's going to be right. And usually in this case, the sellers win and the stock goes into a stage 4 downtrend. This is supply. This is fear. This is where we are now. The last 6 months has been supply and fear. Money is exiting the market. It is not entering, it's exiting the market, okay? It's associated with selling from fearful traders and investors who want to exit the stock at all costs. This stage is usually the fastest moving as fear is more powerful than greed in the market, right? Take the stairs on the way up and the elevator on the way down, okay? So the key here is understanding where we are in the market, not just for trading individual stocks, but for investing purposes as well. You're not going to buy at the top of a stage 2. That's just dumb, stupid, foolish. You're going to buy in the stage 4s and the stage 1s. That's where you're buying stocks. Okay, you don't buy Apple at the all-time high. You buy it on a pullback. Now, to be clear, not all pullbacks are the same. Some pullbacks are shallow and presents an opportunity, but, and this is what the key about today's lecture is, not all opportunities are created equal. And in your lifetime, you're going to get a handful of truly special opportunities. Special, 2008, that was special. The COVID drop of 2020, March 20, that was special, okay? I think we're probably coming into a potentially special period here in the next year. Right? We can replay this a year from now, 2 years from now, and see if I'm right or if I'm wrong. Okay? But when you look back at 2007 and 8, the market dropped some 40 to 50%, from peak to bottom, 50%. Okay? When you look at the COVID drop, the market got hammered. Okay? So what I'm saying here is, yes, buy on pullbacks. When the market has a 10 or 20% pullback, take advantage of that. But when the market has a 30, 40, 50% pullback, back up the truck, okay? So let's take a look at this one more time before we move on to, okay, Let's do this afterwards, okay? Let's do that slide. Let's do that slide next, okay? So this is that sideways apathy accumulation state, right? Take a look at the middle here. Nobody cares right here. The volume is low. The market or the stock is in a narrow range. It's like, I don't care. Why should I care? And then we break out, pull back, go higher, pull back, go higher, pull back. Now, this is how I liken this for those of you that maybe have heard this before, okay? You see, think about this like fashion, all right? When a new product comes out, no one knows about it before it comes out. It's still in the design phase, right? So maybe you have a new pair of jeans or a new bag or a new shirt or whatever, okay? Remember years ago, skinny jeans were popular, okay? Well, how does this happen? Well, someone thinks up an idea and goes, you know what, skinny jeans would be kind of cool. And maybe they work for Ralph Lauren or whomever they work for, doesn't matter, all right? And what do? Where's the first time you see crazy fashion? You see it on the runway, right? It starts in a laboratory, not a laboratory, but it starts in a design center on a desk, and someone goes, I think that's cool, and they sketch it out. And then they make it, and then you find it on the runway. And when people see it on the runway, at first glance, it's like, whoa, that's risque, right? I mean, honestly, how many times do you see something on a runway and go, oh my gosh, I have to have that? You don't. You kind of look at it and go, wow, that's a little, right? So what they do, after they show it on the runway, they start giving a taste to celebrities. Hey, Kim Kardashian, wear this. What happens? Paparazzi follow her around. Starts to pick up steam, right? Starts to pick up steam. More and more people are like, ooh, that's cool. You think it's a joke. It's serious how this stuff works. Deadly serious. Influencers get it. They're wearing it. Oh my gosh, Halle Berry has it. Jennifer Aniston has it. Justin Bieber has a pair. Okay? Right? And then what happens? It starts to pique people's interest. Because when you have 300 million followers on Instagram, people start taking notice. And then it starts making its way to the stores. That's here. Okay, now, liken this to trading. The big banks have an investment banking deal going on in the background. They're talking to people they know. They're talking to companies. Guess what? Then the trading desk gets wind of it. They start buying it up. Right? And then after they start buying it up, it's kind of like some of the smaller banks get wind of it and they start buying it up. And all of a sudden, the pros start taking notice. And then the stock starts to move higher. Right? You get about halfway up here. Finally, it's readily available in stores because initially it was only celebrities. And then it was kind of like you had to be special. Not a celebrity, but a little bit special to get it. And then it started becoming more readily available in the stores. And that's when we're starting to move up here, right? We're moving up. Now we're up here. We're about 70% of the way up. Okay, so now it's a full-blown fashion trend. It's a full-blown trend at this point, okay? So at this point, what do we have? When we relate this to stocks, you have average investors starting to buy some, hedge funds are piling in, this kind of stuff. All your politicians, well, they're in way down here. Nancy's in like at the bottom before the deal was even conceived. Nancy knew about it, okay? Her husband, I should say. Just coincidence, of course. Anyway, back up here. So we're up to that 60, 70% move up. And now you're starting to see the smart money's getting some. Good traders are getting in at that 40 or 50% range. And it starts moving up and moving up and moving up, right? The reason, guys, the mentality works this way is because all the people that got hosed down in 2007 and 2008, what did they do? They cursed the stock market. They said, F the market, I'm never going to invest in that. So when a stock starts to move up, they go, whatever, that's a fake move, I'm not going to participate. Pulls back and they go, see, I told you. Then it goes up, like, whatever. It'll pull up, pulls back, see, I told you. And then it goes up and up and up and up. And what happens to these people? As the stock starts to move higher in the stage 2 greed phase, what happens to these people? FOMO starts to creep in. Fear of missing out is creeping. They're like, well, maybe I was wrong and it's time to get in, but, I still remember 2007 and 2008, and I don't want to do that again, so I'm going to wait just a little bit longer for more confirmation. Yep, this is what the average idiot does. They literally wait for obscene amounts of confirmation. What happens? Stock starts to move up here. Okay? Now, we relate this to our fashion trend. By this point, Kim Kardashian's on to the next fashion style. Halle Berry's on to the next fashion style. And Justin Bieber's already moved on a long while too. Now, right up in here where you see my cursor, we're not quite in a stage 3, but we're getting close. This is where Target starts to pick up the fashion trend. Walmart starts to pick up the fashion trend. It's readily available to everyone. So all the people on the inside, they don't want to be seen wearing clothes that you can buy at Walmart. God forbid. They're off. They're on to the next great thing. Okay? Now, this is also where the average investor starts to go, you know what, I need to get into this. I can't sit back anymore. This is a real thing. This is the real deal. FOMO. And then right after they get in, the stock peaks, the fashion peaks, and now tug of war. And it pulls back a little, and when it pulls back a little, they go, I'll buy a little more. Right? Bounces back up. Remember, this is a tug of war between buyers and sellers, and then it starts to fall. The trend is over now. The uptrend is over. Okay? And now these people that got in at the top, they're not going to sell it. They're bag holders. They're bag holders. Now, it's not even at Walmart anymore, the jeans. They're not at Target anymore. They're at Marshall's or Beal's or some discount outlet now because we're headed for a stage 4 downtrend. Buyers are like, no, it's going higher. Sellers are like, no, it's going lower, and the sellers win. The banks are long gone. They're gone long time ago. They're selling it. This is right about when they upgrade it. Right there. Right about the top of stage 2. It goes a little bit higher after they upgrade the stock, on purpose, by the way, and then it tanks. Okay? Then stage 4 drops, pops, drops. And now these bag holders are going, I can't believe it. I did it again. But I'm not going to get out because maybe it'll bounce. Okay? Long story short, as the stock drops, you know what this is like? I use this analogy in PTS. I'll use it here. There's 100 people in a restaurant. Some people are sitting near the exit sign. Some people are sitting in the middle of the restaurant. Some people are sitting in the back of the restaurant. Someone yells fire as loud as they can. Fire! Get out! Who gets out first? The people sitting next to the door. Right? They're sitting next to it. They get out. No big deal. And then as the people in the middle of the restaurant start running for the door, what happens? That 32-inch door, 36-inch door gets really crowded. And the people in the back get stuck. Guess what? Everyone wants out. But you can't all get out of the same door at the same time. And this is what accelerates the selling pressure. We talked about, remember last week, a couple weeks ago, we talked about how markets sell off, right? The buyers stop buying. The short covering, they don't short cover anymore because they know it's going lower, so they wait. Pushes the stock down. New money sits on the sidelines in cash and they're not putting their money into the market anymore. Well, everyone's trying to get out of that same damn door and they all can't get out at the same time. So some people have to get out lower and lower and lower and lower and lower. And the stock drops faster than it popped. And eventually everyone gets out. And what happens when your restaurant's empty? We don't know if there was fire damage or not. But I don't care. I'm not going back to that restaurant. Bad juju, whatever. Maybe there is fire damage. The point is, we're not going back there. This is that stage 1 apathy, indecision, no one cares. This is when you buy. Okay, now I spent a long time on this slide. But it's very important that you have to understand how this works. Because what you're understanding here is psychology. And once you understand the psychology, you will make way more money, not just as a trader, but as a long-term investor. Because you don't ever buy the top of a stage 2 or a 3. You wait. If it's in a stage 3, it's going to move into a stage 4. Buy it on the cheap. Have some patience and discipline, not FOMO. Guys, I'll give you a personal example of this. I told somebody, 3 months ago, something like that. I said, damn it, I kind of wish I would have picked up some Amazon in the 105, 110 area. I was waiting for it to break $100, and it climbed back up. I got a little bit greedy, and I should have bought at least a quarter, half, third position, whatever. Moved back up to 146. And this person's like, well, what do you really think of Amazon? I said, I think it's a wonderful long-term investment, 10, 20, 30 years. Okay? He said, oh, okay. I said, but I'm not going to buy it here. It just popped 40%. I'm not going to buy it. I'm going to wait because I feel very confident looking at the chart it's going to go lower. What do you think the person did? They bought a half position at 140. Peaked at 146, and what's it at today? 115? 113? I don't know. Something like that. Because they don't have patience and discipline. I picked up a little in the 113 area. I'll buy some more at 105, and I'll buy a hell of a lot more if it breaks 100. They don't have patience and discipline. So they bought some at 140. Now they're down 30%, and they could have just waited a month or two. Have patience and discipline. This happens to all stocks. It happens to the market. So, break the cycle, guys. I'm not done. We have 7 more slides to go. We're not even close to done. Break the damn cycle. People are terrible with money. People carry too much debt. People do not save enough for retirement. People rely too heavily on Social Security for retirement, okay? Most people start saving too late. Most people are over-leveraged. Most people think that retiring rich is impossible. Most people think that you need a huge salary to be a millionaire. Most people simply don't understand money. Most people are broke. This is not rocket science. So break the cycle with your spending habits, okay? And follow the cycle for your investments. Make sense? So break this cycle of downward spiral of death. It's financial slavery what this is. But when it comes to investing, follow the market cycle. Now again, to be clear, not every one of these is going to give you a 50% pullback. There are times when you're going to have to just make do with a 10 or 20% pullback. And over the last 10 years, it's kind of what you had to do. And I'm okay with that. If you want to put like a monthly distribution where you buy Apple or Amazon or VTI or VT Sachs or something, and say you put $100 a month, $1,000 a month on auto debit, fine, go do that. But save some cash for a rainy day. When the market gives you that 20, 30, 40, 50% pullback, you pile on in. Okay? Now let's take a look. Let's take a look. Stop being on the wrong side of the market. The market in 03, 04, 05, 06, 07, 08 went higher. This is the Qs and this is the SPY. Okay? Similar chart. Okay? Higher, higher, higher. We went from $20 all the way to $55 on the Qs. Okay? We dropped, bounced, dropped. Double bottom retest, rip. That was March of 09. $25. Guys, the Qs are at 277 right now. I don't know about you, but that 277 is after the market just dropped 20 or 30%. So the market is up 10x from the bottom of 09, 10x after a 30% drop. I mean, what were the Qs? 350 not that long ago? So basically from the bottom, the market was up like 15 to 1, 1,400%. Think about what I just said there. If you want to talk about wealth creation, you see, guys, in normal markets, the market historically averages about 10.5% over the last 120 years. And that means roughly every 7 years, your money doubles. Roughly. Well, if you bought the bottom in 2009, heck, even if you bought the $30 entry, let's call it $32, the market is up 1,000% in the last 13 years. You should be up 200%. The market's up 1,000. The rich get richer because they know when to buy. Warren Buffett back then gave Goldman Sachs a $5 billion loan. Very, very good idea. So you buy here. Why? That's a pullback, right? That's a pullback to support at $40. Guess what? It bounced and went lower. Okay, fine. You could have bought some at 35, that 30 to 35 area, because there's 3 pivots here. This is what I mean. Not every pullback is going to be massive. That was a nice pullback, right? That was like a 25% pullback right there. Sweet. Buy it up. Buy that at between $40 and $45 right there, right? Buy that. It pivots. Goes lower. Save some money for a rainy day. 7 months later, it bottoms out. You get a double bottom retest and then rip. Same here on the SPY. Pulls back right here. See the big bottoming tail? Somewhere around 120 to 140 right in here. Buy some. Market goes lower. Gives you, again, kind of a double bottom. You're going to buy some at like $82. The SPY went to like 400 and something. But every 7 years you double your money. No, not if you're smart. Okay? Not if you're smart. Stop being on the wrong side of the market. Read the charts. Read the market cycles. Okay? Read the stage 2 uptrend. Read the V top stage 3. Read the stage 4 downtrend. This is how you're going to stay on the right side of the market, and your investments and your trades, by the way. Instead of using a monthly, drill down to a 5-minute. It's the same concept. Now, this is the QQQ weekly chart as of yesterday. As of yesterday. Trend analysis, supply being created. Well, this was the COVID drop. And again, this was an unusual black swan random event. Okay? Still provided with an opportunity. Okay? So, market peaks at like 240, pulls back to like 160 or 170. I mean, the market lost like 30-some% in 4 or 5 weeks. And then what did it do? And one of the biggest bullish runs we've ever seen. It went from 170-ish to over 400. So now, higher high, higher low, 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 fails. Right? This is the trend line in pink here. That's the trend line. Finally breaks the trend line. Bounces, puts in a lower high and a lower low. Here's your first lower low. Here's your first lower high. Here's your second, right? Lower low. Oh, but we have a higher high now. But it would drop, pop, lower high, lower low. So here's a lower low here and a lower low here and a lower low here. There's 3 lower lows, lower high here. We bounce, but we hold the trend line. Right? Redraw the trend line. We hold the trend line. We're back down here. Guys, if we break this area, it's a double bottom retest at the 200 period simple moving average. If we don't bounce here, the market's in serious trouble. Serious trouble. Okay? But here's the thing. You don't know when the market's going to bottom. No one knows this. And anyone who tells you they do is lying to you. I don't know if the 320 area is going to be the low, so I nibble some. I don't know if through 290 is going to be the, so I nibble some. I don't know if 270 is going to be the actual bottom, so I nibble some. I don't know if 240 is going to be the bottom, because that's the previous peak high, so I nibble some. Take your position, divide it by 4 or 5. Say you got 100 grand, divide it by 4 or 5. Say $20,000. Say you have 5 grand, divide it into $1,000. It doesn't matter. I don't care if you have $500. Divide it into $100 increments. Divide it into 5, 4 or 5. You just buy all the way down. Buy all the way down. And you know what? You're probably not going to get to your bottom level. Will we possibly get down to 170 here? Maybe. All I know is if we break 274, it's a soft area. It's a soft area. But the next area is 240. And that's a soft area. An area that we're probably going to slice through. If we break 270, holy shit. That's all I'm going to tell you. Those words. 2 words. Holy shit. There is that much room for this market to drop. You don't all believe it. I'm sitting here looking forward to it. I can't wait for it to happen. I got money sitting aside going, drop some more and drop some more and drop some more and drop some more. Because guess what? It's a 100% chance that the market will get back to 400 at some point. I'd love to buy me some at 200. Love to buy me some more at 170. It's going to get back. It's not an if, it's just a when. It's not an if, it's just a when. Repeat, it's not an if, it's just a when. Okay? Here's the SPY. SPY weekly trend analysis. Okay? Here's the peak. I could draw the trend line, but you get it from the last slide. Moving up, moving up, moving up, moving up, moving up. Pulls back, lower high, lower low. A little bit of a higher high, lower low, lower high, lower low. Hit the trend line, got smacked. Exactly right, John. Wealth is created in bear markets, not bull markets. The fruition of that happens in bull markets, but the creation of it started in a bear market. Okay? So, downtrend line, we hit it. Look at that. Hits the moving average, hits the downtrend line, slap. We break under 360. Oh, goodness me, oh my. Now, with the SPY, a little more room right there, right? A little more room. I'm giving you the answer right here. Where are the buy points? Well, there's one of them. I just gave you one of them. Right around 320. 360 is a good buy point. 320 is a good buy point. Maybe a hiccup at 300. After 300, holy shnikes. Maybe 225. Put your seatbelts on. Put your parachute on. But carry some money with you. I promise you. Guys, the Qs are at $278 right now as I speak. The bottom in 2009 was $25. Let's have a moment for a second. I'm not trying to be, honestly, I'm really not trying to exaggerate this. I'm trying to be deliberate here. But I really want you to think about what I just said. The bottom of the Qs in 2009 was $25. It is now at $278. More than 10x. 10 times your money. If you put 100 grand in back then, you'd be a millionaire today. If you put 5 grand in, it'd be worth 50 grand. Think about that. And that's after the market just pulled back. The Qs were over 400 at one point. Give that some thought. You know why? Because while you can't see it, the Qs will be at 1,000 someday. They will be at 2,000 someday. They will be at 3,000 someday. Remember that the only thing you need to do to reconfirm this, okay, is go look at the real estate market. Remember that house your grandparents bought for 30 grand? Now it's 300, 500, 700. And back then that was considered a lot of money. Seriously, it was. Oh my gosh, they bought a house 40, 50 years ago for 30 grand. Oh my gosh, you paid 30,000 for that? That's a lot of money. It won't be 30 years from now. It feels that way today. It won't be then. Okay? So, what do you think? Is this an opportunity to sell, run and hide, or save, wait, and pounce? What do you guys think? Is this an opportunity to sell, run, and hide? Oh my gosh, I'm a scaredy pants. I'm going to sell for a loss. Go run and hide and curse the markets. Or is this an opportunity for you to be saving up a little bit, waiting, and then pouncing on the markets? I know how I feel about it. And this isn't the first lecture I've given on it. Okay? This is an opportunity, guys. And I'm telling you this, and the reason I've done a couple lectures on this is simple. I don't want you to miss it. I don't want you to miss it. Because you probably missed this pullback, you probably missed this pullback, and you probably missed the pullback in 08 and 09. How many more pullbacks are you going to miss? This shit's going to get ugly. I am telling you. I'm not even surmising. I might be wrong. It's certainly possible. I am so certain of this that within a year or two, 18 months, 6 to 18 months, the market will be lower than it is today. And I am going to be sitting, and I'm going to be waiting, and I'm going to be buying it. And when it bounces back up, everyone's going to tell me how lucky I am. You are so lucky. No, I've been telling you guys this for 6 to 12 months. Just like Bitcoin, Been telling you it's going to pull back. I'm waiting. And when it comes back up, I'm going to quadruple my money. Quintuple it. All right? But you know what? Doesn't matter. Because I'm not getting rid of it in 10 years, 20 years, 30 years, maybe 30 years. Who knows? Guys, it all starts with one thing. Understanding how the markets work. You must understand the psychology, right? It's understanding how people think. If you don't understand how people think, you will think just like an average person, and you will always be behind the trend. Always, 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 always. Always. Because most people are broke. You don't want to be broke. You need to break the mold, and you need to be different. Okay? It's the only way that you're going to get ahead of the average person is to be different. Means think different. Guys, your number one asset in life is time. There is nothing more valuable than time. In investing, time is money. I wish I was in a better position in 2009. I definitely bought a lot of real estate in 2009, 10, and 11. And I did very well. I wish I would have bought more stock market. I wish I would have bought more of the Qs and the SPY back then. Right? I'm not complaining. I'm just simply saying, you look at that and you go, okay, that was one of the largest opportunities perhaps in my lifetime. And I did take some advantage. But next time when I get that big of an opportunity, I will take full advantage. Full advantage. Still in my mid-40s, I still have a lot of time left. If you're younger than me, if you're in your 20s and 30s, oh my goodness, you don't understand how good you have it right now. You may not have as much money as somebody in their 50s because you're in your 20s. But that doesn't mean you can't take $1,000 or $500 or $2,000 and put it in the markets. Okay? The stock market always goes up. Not smoothly, but it always goes up. Not smoothly, but it always goes up. Don't believe me? Think I'm wrong? How do you like them apples? The Dow was at 64 in 1921. The Dow peaked at 36,799.65, January 4th, 2022. That's a 575-fold increase. Where will it be? 2032, 42, 52, probably higher. Right now it's at 29,500. The market always goes up. Okay? But sometimes we get these little gems, right? We get these beautiful little gems. Your job is to take advantage of these gems. Put yourself in the, not the if position, the when position. It's not if this is going to happen again in the market. It's when will it happen again in the market. The panic of 1907 helped to establish a Federal Reserve System. 1929, the most famous and the market lost 89% of its value, and it took until 1954 to get above its pre-crash level. How would you have liked to have bought the market in 1930? Oh, I get chills thinking about it. How nice would it have been to have had some money in 1930? 64 to 82, the stagnation years. We didn't break 1,000 for 18 years. Black Monday, markets lost 22% in one day. Largest one-day drop in history. I think it may have been 25%. I don't know. But it's over 20 in one day. Early 90s recession. Dow lost 18% in 3 months. But look at that. Recovered 9 months later. Okay? The dot-com bubble. The NASDAQ lost 76% of its value during this period. It dropped from 5,048 to 1,139. It took nearly 15 years for the NASDAQ to retest the peak from 2001. And now we're at almost 11,000 on the NASDAQ. Double. 76% drop. Financial crisis. The Dow lost 54% from its peak. It took 4 years to fully recover. This took 15 years. This took 4. That's pretty good. The Dow lost 12.9% in one day, but quickly recovered. Guys, 1, 2, 3, 4, 5, 6, 7, 8. There's 8 events, and there's more in there if I wanted to be more granular. There's 8 events in the last 110 years, 115 years. What am I telling you this for? These things don't fall off a tree. They don't happen all the time. Every 10 to 20 years, you get one of these beautiful events. Sometimes they're spaced quick, like 87 to 90, right? Every 10 to 20 years. Yep. And you sit there and you go, I want to buy at the bottom, not at the top. Again, if you have your monthly regular investing schedule, do that. I'm okay with that. But make sure you have some money set aside for when this stuff happens. Okay? This is how the average person invests. Normal pullback, minus 5%. Just a healthy correction, 10%. Stocks are on sale. I love a good sale, minus 15. Let's see what happens sitting on my hands at 20% down. 25, this is starting to feel serious. I can't touch this for another 15 years at 30% down. Oh, that's a good one. What is happening? I'm out. Thank God I sold. I'll be back. I'll buy back soon. I'm never coming back. That is 2007 and 8 to a T. I mean, like boom, 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 boom to a T. You should be smiling the further it goes lower. Now, guys, I understand. Everyone's in a different position in life. Some people are retiring, and I certainly, if I was like 6 months from retirement, I wouldn't want 2008 financial crisis to happen 6 months before retirement, and the market loses 40 or 50%. It's scary. It is. But it's going to happen. Know it's going to happen. So prepare for that. Don't try to live on everything you have. Try to make enough money so you don't have to live on everything you have. And if you're in a position, take advantage of those things. Okay? Does anyone know how long was the longest bear market? Whether you want to call it bear market or not, Victor, the stagnation period from like 64 to 82, where the Dow did not break 1,000, was pretty significant. I mean, again, whether you want to call that a bear market or not, I would say 1929 and 1964 probably be the 2 times I would say in terms of length. Wow, 18 years for this one, and this one was 25 years. But, I mean, it did lose 89%. Okay? Should have been more aware back then. Back in 09 yeah, I mean, it's okay, Jason. The only thing you can do is prepare for the future. You can't roll back the clock, right? This isn't Cher. I can turn back time. You would find a way, right? You can't. You can only look forward. It's not an if, it's a when. So give yourself a little bit of leeway and say, you know what? I wish I would have done better, but I've learned from it. And the good news is you're going to get another opportunity. Guys, I may live another 40 or 50 years. I may live less. Who knows? This is going to happen another 4 or 5 times in my life, 3 to 5 times. And I'm going to take advantage of it when it does. Okay? You should too. So just remember, draw your lines, draw your levels, take advantage of it. And also, every month, put away some money. I don't care if it's $25. I really don't. I'm serious. You might think, oh, that's nothing. No, it's always something. It's more than you have right now. Stop this negative attitude that some people have. Well, gosh, if I only put $50 away, I'll never retire. Well, how about this? You put the $50 away, and 40 years from now, maybe it's only 200 grand, but you know what? Just give me the 200 grand, okay? Because you don't need it, because it's only 200 grand. That's the most asinine thought process I have ever heard. You put away as much as you can comfortably afford to put away. Okay? I mean it. $25, $10, $100, $10,000 a month. Whatever it is, put that aside. Invest it in the market on auto debit. If you got to get a side hustle for the extra $100, go do that. Chop wood, be a busboy, be a waiter, be a greeter at Walmart, drive Uber, I don't care. Put some money away. Because one day you will be 50, 60, 70, 80, maybe 90 or 100. It's going to happen. Put yourself in a better position tomorrow than you are in today. But it starts today. It starts today. And trust me, and I'm sure we can all attest to this, man, time goes fast. I can't believe it. I had a 14-year-old daughter. I feel like she was just born yesterday. Time goes fast. And I feel like the older you get, the faster it goes. My grandmother's like 87. She's like, it goes in 20-year clips the way it goes in 5-year clips for you. Every 5 years, that's like 20 years for me. Do the right thing. Make your future self respect and thank your current self. I'll repeat that. Let your future self respect and thank your current self. Don't have your future self regret your current self. Help a brother out. Guess why? You're helping yourself. You're helping your friends and your family. You're helping everybody. But mainly, you're helping yourself. Okay? So just remember, draw your lines. Know the market stages. Right? Stage 1, 2, 3, 4. Figure out the areas where it's best to add. And you know what? You won't always be right. But at least you're doing it with a plan. You may add in an area and the market goes much lower. That's okay. You had a plan. You added there. That's fine. Okay? So just give that some thought, guys. All right? We talked about pivots and trends. That goes back to the market. I'm not going to go over this slide. We went over it last week or 2 weeks ago. Same here. Okay? Pivots and trends. The angle of the retracement, angle of the correction, the overall trend quality. This goes back to the market cycle. Understanding human emotion is how you're going to take advantage of human emotion, by actually understanding what it is and where you should be adding and buying. Okay? So, genuinely speaking, I really hope that you guys learn something that will help your future self. I mean this sincerely, because it is sad watching people retire with little money or no money, or relying on Social Security at $1,500, $1,600 as their primary source of income in retirement. You don't want to be that person. And the sooner you start this, the better off you will. Even if you're listening to me and you're 65 or 70, you're still going to need money 5 years from now, 10 years from now. Right? As long as you're living, you're probably going to need money. Do your future self a favor. Save. Save. Live within your means. Be smart. And if you're really young, you have no excuse not to be wealthy by the time you're 50 if you listen to this lecture. If you're in your 20s, you should have a good amount of money 20 to 30 years from now if you listen to this lecture. There's no excuse for it. The world is your oyster. Take advantage of it. All right? So I hope that helped you guys be a little bit better tomorrow than you are today. I am Jared Wesley of Live Traders. We'll get back at it again next week.